Pay very close attention to what I'm about to tell you. COMEX registered silver just hit 88 million ounces. The March contract roll is crawling at 15 million daily when it needs 30 million. At this pace, COMEX hits zero silver by March 6th. The Federal Reserve just injected $18.5 billion in overnight repos, fourth largest injection since the crisis, and the military-industrial complex has become an insatiable silver buyer. This is John speaking. If you actually value unfiltered analysis over what they want you to believe, do two things right now. Hit like, so this doesn't get buried in the algorithm. Share this with one person who's tired of being fed narratives. Not everyone. Just one person who's actually ready to look at the data. Most people can't handle information that contradicts what keeps them comfortable. They'll watch mainstream media tell them everything's fine while the math completely stops working. The ones who verify data already know something's fundamentally broken. You're just looking for someone who connects it all with hard receipts instead of wild speculation. That's exactly what this is. I'm on X under the handle John. That's where real-time data drops before it ever hits here. Follow if you want to be ahead of the curve instead of constantly reacting. Drop a comment below if this is actually making you sharper. The ones who are really learning will add what I missed. Current prices as I'm recording. Silver Western spot is 77. Futures are 77. Shanghai spot is 86. Shanghai futures are 88. $9 premium holding. Gold is $49.91. Price moved above Friday's February 13th high of 79.3, but faced rejection and is now trading around 77.4. High impact news is dropping in 30 minutes. Expect serious volatility. Here's what the data is showing right now. From the beginning of September 2025 until today, registered vault holdings declined from 200 million ounces down to 88 million. That's 111 million ounces drained over 5.5 months, representing an average monthly depletion of 20 million ounces from registered inventory. Some analysts will note there are other stocks held in the eligible category that can theoretically transfer into registered to make market delivery. But keep this critical fact in mind. Registered vault holdings represent the net of inflows minus outflows into the registered category. As the discount for Western cash market silver versus Shanghai grew from $3 to $18 when silver ran over 120 recently. Withdrawals from New York vaults exceeded metal deposits and transfers from eligible into registered. Western silver shipped straight to China to capture that premium. This tells us something crucial. Silver available for transfer from the eligible category vault holdings was, and currently is, inadequate to meet market delivery demand given the global silver shortage we're experiencing. Today's spread in price between New York and Shanghai remains at $9 during the Chinese New Year market pause, offering more than enough spread to cover $2 in shipping and insurance costs to draw silver from New York to Shanghai. The deficiency in net supply of silver moved into the registered category in New York. Vault holdings is resulting in an almost constant depletion rate of roughly 20 million ounces per month. The March to May roll is absolutely crawling right now. It needs to be 30 million ounces per day. Yesterday was only 15 million. At this current pace, COMEX hits zero silver by March 6th. The current rate of registered New York Vault silver drawdown of 20 million per month in comparison to registered vault holdings of only 88 million implies a silver market event and hard reset to significantly higher prices in the very near future unless massive amounts of physical come to market at these lower prices. And historically, lower prices do not typically bring added supply to market. They do the opposite. March open interest still sits at roughly 270 million ounces equivalent versus 88 million registered, just 8 days from settlement beginning. Upward pressure on the March contract is building every single day, and price will need to move sharply higher to persuade March longs to roll forward. The Federal Reserve just injected $18.5 billion into the United States banking system through overnight repos. This is the fourth largest liquidity injection since the crisis. Something beyond normal operations is triggering stress that requires this level of intervention. The people who track Federal Reserve facilities on a daily basis know these signals don't appear during calm markets. They appear when liquidity pressure is building beneath the surface before it becomes visible to mainstream observers. Now let me layer in the military angle that absolutely nobody else is covering. Warfare is eating the world's silver supply. The military-industrial complex has become a massive new insatiable buyer that changes everything about the supply-demand equation. Multiple large-scale attritional wars are raging right now. These wars consume enormous amounts of materials, and silver is absolutely critical to modern warfare. An industry CEO stated publicly that the armaments industry is now expanding capacity in an area where the crucial metal is no longer available. Silver isn't just for batteries and solar panels. It's essential for circuit boards, electrical wiring, contact points, especially in advanced weapon systems. The United States uses it in marine energy storage and missiles for target guidance systems. It's in autonomous torpedoes, which are entirely electrically powered. It's in the new electric and autonomous submarines being deployed. Here's the part that should terrify anyone paying attention. United States Defense Department silver reserves were almost completely depleted by 1995. National Defense silver reserves trended to zero by 2001. They had silver reserves. Keyword: had. Past tense says everything you need to know. Jim Rogers wrote in Hot Commodities about how government stockpiling behavior shifts dramatically during resource scarcity. Nations that ignored strategic reserves for decades suddenly compete aggressively for supply when industrial demand intersects with military necessity. What we're witnessing with the United States defense stockpile at zero, while multiple wars are consuming silver-intensive weapon systems, fits exactly that framework of supply panic at the institutional level. The United States is prepared to strike Iran as early as this weekend, according to breaking reports, though Trump has yet to make the final call. This isn't speculation. This is CNN reporting direct military positioning for potential large-scale action within a specific time frame of days. When geopolitical risk moves from abstract threat to imminent military action within a specific window, markets reprice everything connected to conflict: energy, strategic materials, safe haven assets, all of it. Analysis of CFTC data proves something remarkable. The silver rally from $33 to over $77 wasn't driven by reckless futures speculation. It was built on something much stronger. Managed money net long positions collapsed nearly 90% since mid-2025. In July 2025, net long sat at roughly 45,000 contracts. By December 2025, they dropped to roughly 14,000. By February 10, 2026, just 4,569 net long, the lowest in years. Speculative longs got completely flushed out. They didn't pile in. If this was a classic speculative blow-off, managed money longs would have exploded higher. Instead, they cratered as price climbed, proving beyond any doubt that physical demand led the way. The paper market got shaken out, leaving positions at historically low levels. With big speculators now barely long, silver is sitting on a powder keg. Low open interest plus tiny net longs equals massive room for explosive upside if fresh money returns. Gold to silver ratio sits at 64:1. Mining ratio is 1:8. COMEX vault ratio is 1:11. LBMA vault ratio is 1:3. One of these ratios is about to snap violently, according to metals analysts tracking relative valuations. When physical reality diverges this far from the price discovery mechanism, something has to give violently to restore equilibrium. According to Hartnett's latest survey, his client base has once again identified gold as the most crowded trade. The last time they made this exact call, gold was trading at $32.75. Today it's approaching $5,000. This pattern reveals a persistent irony. Institutional surveys tend to declare an asset crowded at the precise moment before its next major leg higher. The majority is always positioned at the wrong time, responding to recent price action rather than understanding the structural drivers beneath the surface. Gold and gold miners versus global assets sit at a historic low. From 1921 to 1981, the average was roughly 24% of global assets. In 2025, that share collapsed to roughly 4%. To simply return to the pre-1981 norm, gold and miners would need to outperform global assets by roughly 6 times. The gold bull market is not crowded, it's not mature, it's not finished, it's just beginning, according to analysts tracking long-term allocation data. The Western discount of $9 is still enough to pull silver from New York vaults straight to China, even during the market pause. Physical flow direction tells you where real demand sits versus where paper games play out. David Morgan wrote in the Silver Manifesto about how supply crises develop gradually through inventory depletion until reaching an inflection point where price must reset violently higher because physical availability simply cannot meet demand at current price levels. 20 million ounces monthly drain for 5 straight months with 88 million remaining represents exactly that inflection point approaching, where mathematics force price adjustment regardless of paper market manipulation attempts. Let's talk about the bearish case because it matters. The Iran strike could be delayed, removing the immediate geopolitical premium. The Fed repo injection could be a routine seasonal adjustment, not systemic stress. Military silver demand could theoretically be met through recycling or substitution. The March roll could accelerate in the final days, as has historically occurred. Registered inventory at 88 million is still technically sufficient if the delivery percentage stays normal. Managed money positioning could stay low if macro conditions deteriorate. The gold crowded trade survey could actually be accurate this time. Mining allocation underweight could persist for decades longer. This is financial warfare education, not investment advice. But the complete data picture shows registered inventory declining 20 million monthly for 5 months straight. March roll pace is 15 million when it needs 30 million daily. The Fed is injecting 18.5 billion in overnight repos. United States defense silver stockpile has been depleted to zero, while wars are consuming silver-intensive weapon systems. The data proves this rally wasn't speculation, it was physical demand driving price. Gold to silver ratio is at 64, while the mining ratio is 1:8. Fundamental dislocation at historic extremes. Harton had said gold was crowded at 32.75. Now it's approaching 5,000. Gold miners represent 4% of global assets versus a 24% historical norm. Bottom line, physical depletion mathematics don't lie. 20 million ounces monthly drain against 88 million, registered with an inadequate roll pace, 8 days from settlement beginning. Military demand that nobody is pricing in. Fed liquidity injection, 4th largest since the crisis. Allocation data showing metals massively underowned. Ratio dislocation screaming that reversion is coming. Geopolitical catalyst imminent. Lower prices historically don't bring supply to market. They accelerate the crisis. Invest with logic, not hype. This is John, and I'm out.